Morning headlines from IG. I'm Brenda Kelly and today is the 19th of June 2013. Today we have seen the euro dollar persistently at 4-month highs around the 134 level. Now, while we haven't seen an actual breakthrough that particular level, it does mean that if we do see a breach of that resistance, then it will be a very short move up towards 135.50. What is interesting about the euro is that ultimately over the last number of years there has been a fear that there would be a reversibility attached to it, that it would collapse completely, particularly in light of the debt problems and unemployment problems that lie in Europe so far and to date. If you look at even the commitment of traders reports, we've seen a 36% increase in longs on the euro over the recent week. Now, what can often be seen is that when you see such a crowded trade, we can be ready for quite a sharp reversal. And incidentally, our clients here are short by 75% on the euro dollar trade. What is really driving this particular FX pair is the fact that we're seeing a shrinking balance sheet from the ECB versus a very wide one from the Fed, and ultimately this evening the FOMC will give us a bit of a clue as to what's going to happen in relation to quantitative easing and I suppose forward rate guidance on what will happen in regards to the record low rates that we're currently seeing. Now, I'm not expecting to see a huge amount of confirmation of exactly what is going to happen. I would expect maybe the September meeting to give us a better clue as to when to expect some tapering, particularly in light of the fact that we're just starting up the summer. A lot of the data has been ultimately very mixed, and of course Ben Bernanke is more than likely looking to see unemployment decrease a little bit more if he is to taper back these quantitative easing measures that have been in place for the last number of years. If you look in regards to the ECB, what exactly can they do towards this euro strength? Because ultimately, if the eurozone is expecting to export itself out of the recession that it's currently in, a strong euro does not bode all that well. If you recall back in February of this year, where the euro was trading at 137 against the US dollar, there was a plethora of different comments and rhetoric coming from the eurozone and the ECB officials, which said that the euro could look towards negative rates, and up until now we haven't actually seen anything of that particular nature, and I don't believe for a minute that we will see negative rates from the ECB. I think the downside risks, as Draghi himself has put it, may very well outweigh any sort of upside risks that could come off it. For the time being, however, I do feel if we look at euro sterling, a similar sort of situation occurs. We're around the 85, 86 level there, and we're caught in a range since mid-March between 84 and the 86 point. Again, if we go through that 86 pence level, there is a huge compunction to drive up towards that 88 pence level, and given the fact that Ireland, for example, has a huge amount of trade with the UK, this again does not augur well for the exports of that particular country. For the time being, given the fact that the ECB seems to be very much out of tools, options and any choices, and very short on rhetoric, which is actually doing any favours anymore, given how effective they have been in the past, it seems the market is looking for actual action, and I fear that the central bank in Europe is probably a little bit impotent in this regard. I think the euro pairs, any crosses it goes against, will be very dependent on other global central banks, namely the ECB, the Fed, and the Bank of England. For more information, log on to IG.com.